Good morning and welcome to the Harvest Minerals Limited investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question, press send. The company may not be in a position to answer every question received during the meeting itself. However, we'll review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Brian McMaster, Executive Chairman. Good morning, Brian.
Good morning, Paul. Thank you. Good morning, everybody. Thank you very much for taking the time to join. Hopefully you're all familiar with this platform. So there's a very brief presentation, which I'll just quickly run through first. And then we have received a number of questions, some of which were duplicates. So we've gone through today and extrapolated out the duplicate questions, and we've got sort of circa 30 questions. And like I've done in the past, I'll read the question and then an answer. And hopefully at the end of all this, things will be a lot less muddier. So thank you very much, and apologies in advance for having to listen to me prattle on for the next 45 minutes or so. So just running through the presentation quickly, and I would expect that most of you are familiar with a lot of this stuff, but effectively Harvest has one principal asset at the moment, which we've been devoting the majority of our time and expenditure to, and it's called Arapura, and it's a free dig organic natural fertilizer asset in Minas Gerais in Brazil. The significance of the asset is that it's a simple and cost-effective production. That's free digging. There's no waste mining. Materials crushed and ready for delivery and application. It's in a location which is surrounded by extensively by agriculture. So we literally sell our product within a 250 to 300, or the majority of our product within a 250 to 300 kilometre radius of the mine. And since bringing the product online about 2 years ago, we've now had quite stellar year-on-year growth. And as we said earlier in the year, we were targeting 150,000 tonnes in sales, and we've reached that target with a few months left to go in the year. The company has very strong ESG credentials. We have a minimum environmental impact, with the first Brazilian company to be awarded the London Stock Exchange Green Economy Mark. And we have been initiating and implementing various things to become carbon free. I think we've talked about this and made announcements about this in the past. We have installed a solar facility which accounts for our electricity use, and in effect the only non-environmentally friendly aspect of what we do is the diesel that goes into the trucks, which the majority of which we don't control. They're owned by delivery companies or the farmers, and the diesel that goes into our digging equipment. And in order to counterbalance that, we have an initiative where we've been planting trees. I think last year we planted sort of 18,000 trees, and we continue to do so over the course of the coming years. So the next slide talks, and I'm probably not going to go through that in detail. It's a little bit detailed, and this presentation will be announced to the market shortly, so you'll have the opportunity to read it yourself. But it does talk to the macro picture of Brazil and the importance of fertilizer to Brazil and the importance of what we're doing and where we are. But some of the high-level aspects of this are that Brazil is the third largest exporter of agricultural products in the world. Sort of roughly 85% of its fertilizer is imported. The government has stated now for a number of years that it wants to reduce reliance on imported fertilizers down to around about 45% by 2050. The need for Brazilian crops is increasing year on year. Fertilizer prices continue to increase, and sort of circa 70% of all fertilizer used in Brazil is applied to the crops, which are right in the heartland of where we are. So we are a very small fish in an incredibly big pond, and it is continuing to get bigger and bigger. And part of the significance of what we're doing is that we are a bit of a niche player. We are 100% organic, we're 100% local, and they are important characteristics that the farmers are looking for going forward. So just touching on our results a little bit, and some of the questions, or the majority of the questions we've received, talk to this slide in particular. So we'll get into the detail of this a little bit, but we have announced that we've received sales orders year to date of 153,000 tonnes, which is roughly double that of this time last year. Q3 sales orders of 32,000 tonnes, which was down on the same period last year, which can it can be accounted for by timing issues. We have healthy profit margins. We've exceeded our overall yearly target. The buoyant fertiliser markets are continuing. We're cash flow positive. In the interim results, we speak to, and this is in the audited accounts, where net cash inflows for the 6 months ended June were just shy of $700,000. We made a loss after tax of $880,000. The 1.5 roughly difference between that is just the write down of some assets which we announced earlier in the year. And at the end of June, we had cash and well, it's called cash and cash equivalents, but it's cash of just shy of $2.5 million. The next slide, again, it's quite detailed, and I won't go through it because it's very difficult to create a story or a commentary around this without boring people too much. But you can just see, the key buying periods for the various crops, and how, as we start to get an impact into some of these other crops, they have less seasonality to them, and it helps spread the load for us over the course of the year. So, for example, when we first started out, we were pretty much uniquely coffee. Now, as we get involved in hortifruit and vegetables like lettuces and things like that, which are becoming an important part of what we're doing, they don't have a seasonality. Compost, again, spreads itself across the year. So there are various avenues that we're pursuing now to try and even out the lumps and bumps of the business. The next slide is effectively a drone shot of the processing facility. You can see on the left there is a pile of product there under some tarps. That is where we're currently in the closing stages of opening up a new shed. So effectively we've built 50% of this shed capacity again where that dump is. And that is, we've talked about this numerous times to the market, that is to keep more product dry, because the Achilles heel of the operations is when the product gets wet. What you can see a road that is sort of stretching out from behind this shed up around sort of the back of the hill. That is where the mine face itself is. It's just at sort of the end of that road. I think we've sort of talked about this a little bit, but it's an important thing for large parts of the investor community, and they are continuing to become important characteristics. It's an important thing for our customers, and it's an important thing for us as a company that we remain committed to our ESG standards and that we continue to pursue a zero carbon strategy. And we are a long way down that path, which is being recognised, as I say, by the London Stock Exchange awarding us with the Green Economy mark. The IBD recognition there says that we've been recognised in Brazil as an organic product. Sorry. So in terms of the investment case, I mean, the highlights are, and hopefully if you're on this call, you've come across this bridge already, but we have a long life flagship project in the heart of Brazil's agricultural market. We're rapidly building brand awareness and reach. We have a strengthening balance sheet. We're focused on growth. We have robust ESG credentials, and we say an exceptional team, but judging by the emails I've received lately, not all would agree. So thank you for listening to the presentation. As I said, and I do apologise if this is monotonous, but I'm going to whip through the questions, and hopefully that will help solve some of the problems. Just while I'm here, there are questions coming through on the chat, and I can see somebody says, can we get a copy of the slides, please? And the answer to that is yes, this presentation will be released to the market. So in no particular order, this is just the way the questions have been presented. It says, how many of the year-to-date 153,000 tonnes of sales does the company expect to book as revenue in FY 2022? So we're going to work on calendar years here, which is also a financial year for us. But the answer is, as at year-to-date September 2022, so that's September 30, of the 153,000 tonnes, 93,000 of them have been booked as revenue. and the company, the team on the ground in Brazil's expectations are that the whole 150,000 tonnes will be booked out by the end of the year. The next question says, when do you expect to be cash flow positive from your operations as opposed to getting loans and classing them as positive cash flow? We don't get loans and class them as positive cash flow. That would obviously be a fundamental mistake and breach of accounting standards. The loans get recorded on the balance sheet as a loan. And as the half-year accounts say, and I've just reiterated here, we are already cash flow positive. The next question, you stated in the Q3 update that the sales margins are 55 to 60%. Is this the average gross margin? Why has it fallen from the July guidance of 75 to 80%? And is this figure should we now employ for the full year? The variation in that margin relates to some amortization and rehabilitation cost expenses, which are calculated by the auditors based on a per unit of production and sales. So, well, per unit of production. So as our production has risen substantially, those costs have risen. Well, they're actually non-cash costs, but they are, from an accounting entry perspective, they are costs nonetheless, have risen as well. And the auditors say that because of the variable nature of those costs, i.e. they are related directly to the volume that we sell, that they want to include them in cost of sales. So the answer is there has been no increase in overall costs, but based on advice from our auditors, there has been a rescheduling of where those costs sit in the profit and loss cascade, and now those two cost lines will be included in our cost of goods sold, and they do have an effect on our margin. But they don't have an effect on our net margin because, as I say, there is no increase in costs. So hopefully that's not too convoluted, but it does mean that we will be looking at those lower margin rates going forward. If average sale prices are not disclosed, how should investors evaluate whether it is worth paying X pence based purely on tonnage sold? Yeah, look, I'm not 100% sure what that question's trying to get to, other than to say, in the audited accounts, we talk to revenue of 2.735 million, and we say we sold 35,000 tonnes. So I think it doesn't take much arithmetic to work out that's roughly $78 a tonne. Could you please clarify the recent restatement of the cost of mining in the interims for last year's interims? The figure has increased by just under $160,000. The answer to that is, again, it was something that was brought to us by the auditors. It's a reallocation of a consumable cost related to the Arapura mine that were previously classified in other expenses. And the auditors, on doing this year's work, said that they don't believe that that cost line should sit in other expenses anymore, and they wanted it reclassified, and therefore by reclassifying it, we had to go back and amend last year's comparatives. So it's not an increase in costs. There's not $160,000 that's just been pulled out of thin air. It's just simply a little bit of a movement of the deck chairs. The next question reads, in the July Investor Meet Q&A, you stated most farmers are given lengthy credit terms to fully pay for KP Fertile. To me, that would seem that the majority of this year's 153,000 tonne sales orders would be fully paid for when farmers get their crop in the summer of 2023, etc., etc. I'm not sure I said the majority of farmers get long credit terms, but certainly it is the case that some farmers do. And I've talked previously on this forum and others about how we've been working with banks to try and create credit facilities. And now, as we are recognised as fertiliser, that becomes even easier to help iron out that bump for us. But where we sit as at today is that so far for this year, 97% of our customers are paying on 30 days. So it's not such an issue for us at the moment. The next question asks basically where any deposit payments recorded in the accounts. At the moment, we're not carrying a material number of of deposits. As I've said, we've invoiced the majority of the product that's been ordered. I think the deposits total roughly something like $150,000, and they are recorded as a set off against the debtors number. The next question reads, this has been an unusual year with the profile of demand for KP Fertile front-loaded to Q1 and Q2, with Q3 being slightly lower. Do you expect the profile of demand, regardless of overall volumes, to revert in future years to building up such that Q3 is the peak demand for future years, with 2022 being an anomaly? The answer is, look, I really am not 100% sure. I mean, that's why we talk at the start of the year about an annual target, because within an annual target, it's quite difficult for us to have really meaningful quarterly expectations, because there are so many factors which are outside of our control which dictate how farmers respond. So an example of some of those factors would be obviously the weather, would be what type of crop the farmer is producing, obviously the broader macro environment, and all those sorts of things. So yes, things got front loaded a bit this year, and I think that was probably, in fairness, the majority of that was a little bit of a run to a safe haven, given what was happening in the Ukraine and Russia. Do I expect that to continue for next year? The answer is I don't know, but we would expect that our overall sales targets will continue to grow year on year on an annual basis, and how that works within that on a quarter by quarter basis, we just have to see how the cards are dealt. And I'm not sure that it's massively important how we deal with it on a quarterly basis. I think the proper way to assess the performance of this business would be on an annual basis. The next question would be, the 2021 H1 costs shown today don't match the H1 costs published September last year. Again, as I mentioned a moment ago, that's because of the reclassification of certain expenses that was pushed through by the auditors. Somebody asks, how many customers does Harvest have? At the moment, it's active customers at circa about 300. Questions again about gross margins. It was noticeable that directors' fees rose 32% over the comparative period. Why such a rise? This was due to the timing with invoices received in a prior year. Refer to the full year financials, and you'll see that on the annual basis, the directors' fees remain consistent. So effectively, not all of the directors invoice on a monthly basis. For example, Luis and I invoice the company on a 6-monthly basis, and I think that, frankly, last year, one or both of us didn't put the invoicing in time, and it just didn't get recorded in the right period, and that's the reason for that. But as we say, if you look at the full year accounts, you'll see that there has been no change. So somebody asks, what do other quote unquote other expenses relate to, given they remain as a significant figure? They are effectively an amalgamation of an overhead cost line in Brazil for the main office and admin staff at the Arapura site. So it's just simply a lot of small things grouped together and effectively constitute, for want of a better term, main office expenses. The next comment is, it is good to see an increase in inventories to meet soaring demand and combat weather issues. Can you advise as to whether these inventories are held at cost, and how many tonnes did $350,000 broadly represent at the end of H1? The answer is, inventories are valued at the lower of cost and net realisable value. Raw materials, purchase cost, and finished goods, cost of direct materials and labour, and an appropriate proportion of variable and fixed overheads are based on normal operating capacity. HMI's balance sheet shows trade and receivables of 318 marked as non-current. What does this relate to? The answer is, it's recoverable taxes in Brazil. We've reclassed them as non-current as they are going through various tax reporting procedures, and the timing for collection is unknown. But it's something that we're expecting at some point when the taxing authorities in Brazil get around to reviewing it, will receive those funds. It says, can you confirm if you expect the average sale price to be higher in H2? How is management viewing the current trends in pricing more generally? Look, the answer is we've spoken to this before. We obviously are monitoring the environment closely, and where possible, we're pushing through price rises. We have put through 3 price rises this year, and in percentage terms, the price that we were charging in Q1 compared to the price we're charging now, it's 25% roughly more now than it was at the start of the year. Can we, continue to do that for the remainder of this year? The answer is we'll have to see. I'm not sure. It's something that we continue to monitor, but it is a balancing act between putting price rises through and stifling the business. So it's just one of those things we keep watching. So the next comment relates to the royalty expenses. It said they were 4% for the period, which appears high. It's the same every year. It's 4%. It's 2% to the government and 2% royalty to the person who we purchased the asset off. So that's just the way it is. So the next question says, referring to the April 2022 borrowings of 3.5 million real for the purchase of equipment and machinery, can you confirm, was this to enhance production or process, or whether it represented maintenance of the current production assets? As we say, it was for the purchase of equipment, so it wasn't for maintenance. It was actually to acquire new equipment, which was needed for the expansion of the operation. One of the things that's interesting is that, in terms of bank debt and those sorts of things, Harvest is effectively a startup. We have no credit rating. We had no track record, and it took quite a long time and quite a convoluted process for us to be able to borrow those funds. And part of the reason we did it was to help establish a track record of being in the banking system and having a credit rating. But again, as in order to be classified as a quote-unquote good citizen, we have actually discharged those debts. So you will see at the full year accounts when they get released that we have repaid those debts in full. The latest interim results state the company is maintaining its 2022 year-end sales target of 150,000 tonnes. Given sales are already at 153, can you confirm the figure is the 150k figure is a target for invoice sales this year? The answer is, I mentioned it earlier, yes, I can confirm that. Going as fast as I can, I've got one page to go, and then I'll answer a few of the questions that have come through while I'm talking. In H1 2021, the cost of goods sold, we've covered that off, I think. Do you anticipate the reversal of the timing of orders seen in 2022 to become the norm? I'm actually not sure what that question means, so I'll have to skip that, sorry. So I'm just reading through these as we go, I think, because some of them are starting to become duplicates. Does the CapEx recorded in H1 2022 represent the FY commitment, or is there still more to come through in H2? There might be a little bit more. If it is, it's roughly tens of thousands. It's not a material number. We're just tidying up some odds and ends here. But once that comes through, we don't have any plans at the moment for further CapEx. So we're it'll be steady as she goes from here in terms of CapEx for the foreseeable future. How confident are you that the 2022 sales can be repeated or even bettered in 2023? Well, I guess the only thing that we can do to gauge confidence from that would be to look at the past and use it as a proxy for the future. And we've had some pretty stellar years, despite anyway, we've had some good years over the last few years, and the feedback we get from our customers and our expectation for the future is that should continue well into the future. So yes, we do remain very confident. Why do you avoid providing forecasts? And I think we got asked this question last time we did an Investor Meet presentation, and the answer remains the same. And the answer is, as I said earlier, it's really difficult to have the operations of this business fit into a neat and tidy quarterly box. I mean, the farmers who we rely upon to sponsor our business, they don't respond to quarterly dates on a calendar. They respond to bigger issues such as the weather, such as demand, etc., 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 etc. So the reason we don't put out monthly forecasts and detailed forecasts is because the likelihood of us achieving them on a quarter-by-quarter basis is something completely out of our control. That's why we do put out annual forecasts, and we say through those annual forecasts that this is our expectation for the overall year. Now, we can't necessarily tell you whether that will all happen in Q1, 2, 3, or 4, but sometime between now and the end of the year, this is our proper estimate of what we expect to do. And we'd like to be able to do something more detailed than that, but unfortunately, we can't. And as you can see from what's happened earlier this week, if we put material into the market that isn't concise, or we miss targets, or people misinterpret what's going on, the ramifications for the share price can be severe. So it would seem foolish, unfortunately, for us to volunteer to put forecasts into the market that we know are going to be subject to a whole heap of variables which are outside of our control. The next question is, what is your current dry storage capacity? It's roughly 50, maybe 60,000 tonnes, sort of in that order. It's 2 lots of 25 to 30,000 tonnes either side of the operating plant. Do you need to raise more funds to support expansion plans? The answer is no, we do not. What plans for expansion do you have for 2023? At the moment, we think we have sufficient capacity to get through our expectations of demand for next year, so we don't have any plans for further capex expenditure and expansion. However, if the market dictates and drives us in another direction, we can respond to that quite quickly. So that's pretty good. So I'm just going to quickly run through, if I can, these questions are coming through already. So somebody says, it is not possible to use maths to work out the selling price when you have been 3 price rises. Can you give us the current selling price? Well, I think, at the end of the day, the statement was that if you divide the revenue number by the number of tonnes sold, you will see what the average selling price is. And I think, that gives you more or less the answer. So apologies if that wasn't clear. Any update on the Edwards family holding that appears to be sold lower? Are you engaging with them? The answer is, look, it's clearly not appropriate for us to talk openly about what individual shareholders don't want to do. We are engaging with them as shareholders, but we don't engage with them around their investment decisions. That's for them to make a decision on, not us. Do we expect them to be selling more in the near term? The answer is no. But is that a statement of fact? The answer is, again, no. I'm sorry, but it's not our place to tell other shareholders what shareholders are thinking. So somebody's asked here, what is the theoretical maximum production tonnage? That, unfortunately, that question concerns me a little bit, because we've probably spoken about that ad nauseum for 5 years now. And the nameplate capacity of the plant is 320,000 tonnes, and it's a little bit concerning that somebody, at this stage of our evolution, is still asking those sorts of questions. And again, that same person is saying, to what extent could exports fill some of the order gaps on your slide presentation? We don't have any order gaps in our slide presentation, which is clearly demonstrated by the fact we've already reached our annual target. And again, for 5 years or more, we've been, ad nauseum saying that this product is not available for export. It doesn't lend itself to export. It won't be exported. And that's the thing. And again, I'm highlighting these couple of comments because none of this is new material. If you're a shareholder and you don't understand those fundamentals, I really do encourage you to go back and read some of the announcements from prior years, because we're not hiding things under a bushel here. Everything that people need to know to understand the business is out there. You just have to take the time to understand it. And if you don't understand some of those fundamentals, I think that's a really concerning aspect of your investment criteria. I'm just reading through these the rest of these questions, and some of them are unfortunately I just can't answer, or they're just not appropriate to answer. So I think, Paul, we might be able to draw a line there.
Sure, no problem at all. And of course, any questions that do come through post this, Brian will have the ability to review those. We can publish responses where appropriate to do so on the Investor Meet Company platform. And Brian, just on that basis, before we redirect investors to give you some feedback, and of course, a recording of this presentation and the slides will be available on the Investor Meet Company platform. I could just ask you for a few closing comments, and we'll redirect the attendees to give you some feedback. That would be great.
Yeah, well, I think as a starting comment, certainly on behalf of myself and the rest of the board, we sincerely apologise for the confusion that seemed to have been created by the release of the annual accounts. There, whilst the nuances in the difference between sales orders and sales as recorded revenue were clear to us, it now works out they weren't clear to some others, and that was certainly an oversight on our part, and one that's clearly unsatisfactory. But as I said a moment ago, and I've had this kind of sense for a long time now, and I don't know how to address it without sounding like a bit of a whinger. But the truth is, a lot of the feedback we get from shareholders is right in the minutiae of the business, and it's always angled at this idea that shareholders are trying to catch us out in a lie, or trying to catch us out with a trick, or they think that we've done something that's just not true. And it's simply not the case. I've said this repeatedly, that the business is extremely simple, and it remains extremely simple. And all of the information that we can put into the market, we put into the market. And if something goes into the market and you don't understand, it is almost certainly a misunderstanding, and reacting with your finger and selling your shares really should be the last thing you're trying to do, because just a 5-second deep breath would understand that this business has been going one way as a business for a number of years now, and that is it's going upwards, and it's getting bigger, it is cash flow positive, it's ticking a lot of boxes. And so if you keep that overall framework in your mind and think, well, hang on a second, something's been released and it doesn't reconcile with that, it's either a misunderstanding or a mistake. Selling the shares was, unfortunately for those people who got trigger happy, was really a not so smart thing for them to do, and not so smart thing for the rest of us. So we try as best we can to ask questions. We don't answer questions. We don't answer questions when people send us abuse, which we get quite a lot of. But I've just taken a stand now, and I just refuse to answer people who send me abusive questions. But where we can, we do answer them, and we try to answer them as quickly as possible. And we try to be as open and as transparent as we can in the market. So, and if this doesn't satisfy you or doesn't reconcile with how you think the company should run, then unfortunately I think either Harvest is the wrong investment for you, or I said on the TMS podcast the other day, we're the wrong board for you and you need to make a change. Which reminds me, somebody actually put a question up, sorry Paul, about why can't the AGM be held in London, which is a good question. And which is a good question. The answer is Harvest is actually an Australian company, which is governed by the Australian Corporations Act. And unfortunately, pursuant to the Australian Corporations Act, we must hold the shareholders meeting in Australia. We did make telephone facilities available, so there was the option, and we did hold it within business hours in the UK. So there was the opportunity for people to engage if they wished, and we encourage you to. Anyway, I gather by the comments that are coming through now, I haven't satisfied many people, Keaton in particular, whoever you are, but sorry about that. Maybe go sell your shares, chap. Get onto something else and do something more productive than giving me a hard time because I'm not interested. Anyway, that's it, Paul. Thank you very much.
Fantastic. Brian, thank you very much indeed for updating Investors Day. Can I please ask investors not to close the session? You should be automatically redirected to provide your feedback in order the management team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of Harvest Minerals Limited, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good morning.